There are financial shifts that occur beneath the surface of daily market activity, invisible to casual observers, but devastating in their cumulative effect. Capital does not announce its departures. Investors do not issue press releases explaining why they are losing confidence in particular markets or jurisdictions. The movement happens in spreadsheets, in allocation decisions, in quiet conversations between fund managers who recognize deteriorating conditions before those conditions become public knowledge. By the time capital flight becomes visible in official statistics, the damage is already irreversible. In late 2025, something unprecedented began occurring in North American financial markets. Capital that had flowed reliably toward American assets for generations started redirecting toward Canadian investments at volumes that suggested not temporary rebalancing, but fundamental reassessment of where wealth could be preserved and grown safely. This was not driven by interest rate differentials or currency fluctuations. This was driven by institutional investors concluding that political stability, regulatory predictability, and fiscal sustainability had shifted from attributes that both countries possessed to advantages that increasingly belonged only to Canada. Most people believe that American financial dominance is permanent, built on the dollar's reserve currency status, the depth of American capital markets, and the scale of American economic output. The assumption is that global capital will always flow primarily toward American assets because no alternative offers comparable liquidity, returns, and security. That assumption is encountering realities that money managers cannot ignore, regardless of historical patterns or political preferences. The first indication of shifting capital flows emerged in corporate relocation decisions that initially appeared to be isolated responses to specific policy disputes, but gradually revealed themselves as components of broader strategic repositioning. In August 2025, 3 major American technology companies announced plans to establish primary operational headquarters in Toronto and Vancouver, while maintaining only nominal headquarters presence in the United States for legal purposes. The companies framed these moves as expansions into Canadian markets, but securities filings revealed that substantial portions of corporate assets, intellectual property, and executive leadership were being transferred to Canadian subsidiaries. The pattern repeated across industries. Financial services firms opened Toronto offices that were staffed and capitalized at levels suggesting they were intended as primary operating centers, rather than branch locations. Pharmaceutical companies transferred research operations and patent portfolios to Canadian entities. Manufacturing firms restructured supply chains to route production through Canadian facilities that would serve as hubs for North American operations. Each individual relocation could be explained by specific factors: talent availability, regulatory environment, proximity to research institutions. But the cumulative pattern revealed something more fundamental. Corporate leadership was hedging against American political and fiscal instability by establishing operational capacity in Canadian jurisdictions, where regulatory frameworks were more predictable and where political dysfunction was less likely to disrupt business operations. The capital flows associated with these relocations were substantial. Securities and Exchange Commission filings showed that American companies transferred approximately $127 billion in assets to Canadian subsidiaries during the final quarter of 2025 alone. This was not foreign investment in the traditional sense of American companies building facilities abroad. This was corporate restructuring that moved control, ownership, and economic activity from American to Canadian jurisdiction. The tax implications of these relocations were creating fiscal pressures for American federal and state governments that depended on corporate tax revenue. Companies that maintained legal headquarters in the United States while operating primarily from Canadian locations could structure their affairs to minimize American tax liability while keeping most operations beyond the reach of American tax authorities. The individual investor response to American political dysfunction created an even larger capital outflow that was harder to track but more consequential in its aggregate impact. High net worth individuals who had historically kept the majority of their wealth in American investments began diversifying into Canadian assets at levels that suggested they were preparing for scenarios where American political stability could no longer be assumed. Private banking data from major Canadian financial institutions showed that American clients opened approximately 47,000 new investment accounts in Canadian banks during 2025, with average initial deposits exceeding $3.2 million. The total capital inflow from American individual investors reached approximately $340 billion, according to estimates from the Bank of Canada's capital flow monitoring systems. These were not speculative positions or temporary portfolio adjustments. These were wealthy Americans establishing permanent financial presence in Canadian institutions as insurance against scenarios where American banking systems, currency stability, or property rights might be compromised by political decisions. The profile of investors making these moves was particularly significant. These were not marginal figures making emotional decisions based on partisan politics. These were corporate executives, financial professionals, technology entrepreneurs, and inherited wealth families who possessed sophisticated understanding of risk management and who were making calculated decisions about where capital would be safest over multi-decade time horizons. The real estate dimension of capital flight created visible impacts that average citizens could observe even without access to banking data or corporate securities filings. Luxury real estate markets in Vancouver, Toronto, and Calgary experienced demand surges driven primarily by American buyers who were purchasing properties not as investments, but as personal residences they could relocate to if American political conditions deteriorated further. Real estate transaction data showed that American buyers purchased approximately $28 billion worth of Canadian residential property during 2025, with concentration in high-end markets where properties were being acquired fully paid in cash. These were not mortgage-dependent purchases subject to financing constraints. These were liquid wealth being converted into tangible Canadian assets. The Canadian banking system's response to these capital inflows revealed how dramatically the competitive dynamics between American and Canadian financial institutions had shifted. Historically, Canadian banks operated in the shadow of larger American institutions, competing primarily on service quality since they could not match the scale or sophistication of American financial giants. By 2025, Canadian banks were being recognized by international rating agencies and institutional investors as more stable, better capitalized, and less vulnerable to political interference than their American counterparts. This reputation shift was creating competitive advantages that allowed Canadian institutions to attract deposits and investment mandates that would have automatically gone to American banks in previous decades. In November 2025, MSCI, the global index provider that institutional investors use to guide allocation decisions, upgraded Canadian financial institutions while placing several major American banks on negative outlook due to concerns about political risk, regulatory uncertainty, and exposure to commercial real estate portfolios that were deteriorating as corporations relocated operations. The MSCI actions triggered mechanical selling of American bank stocks by index funds and institutional investors who were required to match index weightings. Approximately $67 billion flowed out of American financial institution stocks during the subsequent month, with substantial portions redirecting toward Canadian bank equities that were now weighted more heavily in global financial indices. This was not opinion or analysis that could be dismissed. This was structural reallocation by institutional investors who were required by their mandates to follow index compositions. When index providers determined that Canadian banks represented better risk-adjusted exposures than American banks, global capital followed regardless of political considerations or national loyalties. The currency implications of sustained capital outflows were creating pressures on the U.S. dollar that Federal Reserve officials were monitoring with increasing concern. The dollar's value is supported partly by global demand driven by its reserve currency status, and partly by capital inflows from foreign investors seeking American assets. When capital flows reverse and American investors themselves begin moving wealth into foreign currencies and foreign assets, it creates downward pressure on the dollar that cannot be easily counteracted through monetary policy alone. Interest rate increases that might normally attract capital become less effective when the capital flight is driven by political risk rather than return calculations. Currency market data from late 2025 showed the Canadian dollar appreciating against the US dollar by approximately 8.3% over 6 months, the largest sustained appreciation since the commodity boom of the mid-2000s. But unlike that previous appreciation, which was driven by high commodity prices, the 2025 movement was driven by capital flows reflecting perceived stability differentials. The pension fund dimension of capital reallocation had particularly significant implications because pension funds operate on multi-decade time horizons and cannot afford to make allocation errors that would compromise their ability to meet future obligations. When major pension funds begin reducing American exposure and increasing Canadian allocation, it reflects institutional judgment that decades-long trends have fundamentally changed. The Canada Pension Plan Investment Board, which manages approximately $570 billion in retirement assets, released its 2025 annual report, showing that it had reduced allocation to American equities from 42% to 31% of total portfolio, while increasing Canadian equity exposure from 15% to 23%. The explanation provided was that Canadian assets offered better risk-adjusted returns given evolving political and economic conditions. This reallocation by Canada's largest pension fund sent signals to global institutional investors that Canadian fiduciaries were losing confidence in American assets. European pension funds reduced American equity allocations by an average of 4.2 percentage points during the final quarter of 2025. Asian sovereign wealth funds similarly reduced dollar-denominated bond holdings by margins that approached $180 billion in aggregate. These allocation shifts represented hundreds of billions in capital that was redirecting away from American markets toward alternatives, including Canadian assets, European bonds, and Asian equities. The magnitude was sufficient to affect American borrowing costs, equity valuations, and currency stability in ways that monetary policy could not fully offset. The venture capital and startup ecosystem provided another indicator of how dramatically capital allocation patterns were shifting. Technology startups, which had historically gravitated towards Silicon Valley based on access to venture capital and talent, were increasingly choosing to establish in Canadian locations, where regulatory environments were more favorable. Venture capital investment in Canadian technology companies reached $41 billion during 2025, an increase of 127% compared to the previous year. Much of this capital came from American venture funds that were deliberately seeking Canadian startups as alternatives to American investments that carried increased regulatory and political risk. When venture capital begins flowing toward foreign jurisdictions at rates exceeding domestic investment growth, it signals that the innovative capacity and future economic growth is perceived as being more likely to occur outside American borders. The brain drain accompanying capital flight created human capital losses that would affect American economic capacity for generations. When companies relocate operations, when startups establish in foreign jurisdictions, and when wealthy individuals move residences, they take with them the talent, expertise, and networks that drive innovation and economic growth. Immigration data from Canada showed that approximately 87,000 Americans applied for Canadian permanent residency during 2025, the highest level recorded since data collection began. The demographic profile of applicants was heavily skewed toward highly educated professionals in technology, finance, medicine, and other fields that represent disproportionate economic value. These were not refugees fleeing poverty or conflict. These were successful professionals who had options and who were choosing Canadian residency based on calculated assessments that quality of life, political stability, and economic opportunity were becoming more favorable in Canadian locations. The fiscal implications of capital flight and corporate relocations were creating budget pressures for American federal and state governments that were already struggling with unsustainable debt trajectories. When corporations move operations to foreign jurisdictions, they take their tax base with them. When wealthy individuals relocate, they remove high-income earners, who contribute disproportionately to tax revenue. State governments in high-tax jurisdictions were experiencing this most acutely. California, New York, and Illinois reported significant declines in personal income tax revenue during 2025 that state budget officials attributed partly to high-income residents relocating to lower tax states, but increasingly to residents leaving the United States entirely for Canadian locations. The Congressional Budget Office, in a restricted briefing to senior congressional leadership in December 2025, reportedly estimated that corporate relocations and individual departures would reduce federal tax revenue by approximately $73 billion annually by 2027, with state and local governments losing an additional $41 billion in tax capacity. These revenue losses would occur precisely when American governments faced increasing debt service costs, aging infrastructure requiring replacement, and social program obligations that were growing due to demographic aging. Canadian fiscal authorities, meanwhile, were experiencing the opposite dynamic. Corporate relocations were expanding Canadian tax base. Wealthy immigrants were bringing both capital and ongoing income that would be taxed by Canadian authorities. The resource boom from increased global demand for Canadian energy, minerals, and agricultural products was generating royalty revenue that strengthened provincial budgets. The Canadian federal budget released in March 2026 projected surpluses for the subsequent 5 years based on conservative assumptions about revenue growth from corporate taxation, resource royalties, and expanded economic activity driven by capital inflows. The contrast between fiscal trajectories was stark and was being noted by credit rating agencies that assess government debt sustainability. In January 2026, Moody's upgraded Canada's sovereign credit rating, while simultaneously placing the United States on negative outlook, citing concerns about fiscal sustainability and political dysfunction affecting policymaking. The sovereign credit actions had mechanical effects on global bond markets, where institutional investors were required to hold minimum percentages of their portfolios in AAA-rated sovereign debt. When Canada was upgraded and the United States was placed on negative watch, institutional capital flowed from American to Canadian government bonds regardless of yield considerations. The borrowing cost implications were significant. The United States government faced marginally higher interest rates on new debt issuance due to perceived credit risk deterioration, while Canadian governments benefited from lower borrowing costs that made fiscal management easier. The private equity and institutional investment community was adapting to these new realities by restructuring portfolios to reduce American exposure and increase Canadian allocations beyond levels that traditional diversification models would suggest. Investment committees at major institutions were overriding quantitative models that recommended heavy American weights based on market capitalization, instead implementing judgmental overlays that reduced American exposure based on qualitative assessment of political risk. These allocation shifts were being implemented quietly through gradual rebalancing rather than dramatic one-time adjustments that would move markets. But the cumulative effect of thousands of institutional investors, each reducing American exposure by several percentage points, amounted to hundreds of billions in capital redirection that was creating persistent downward pressure on American asset prices. Market observers who tracked fund flow data could see the pattern emerging, but most public commentary was not yet connecting individual data points into recognition of the broader trend. Financial media continued to discuss American markets as if traditional patterns remained intact, while the actual allocation decisions being made by sophisticated investors reflected a different reality. The wealth preservation strategies being employed by ultra-high net worth families provided the clearest indication of how seriously informed investors were taking political risk in the United States. Family offices managing multi-generational wealth were implementing strategies that their advisors privately acknowledged were designed to protect against scenarios including American currency crisis, political instability affecting property rights, or social unrest disrupting business operations. These strategies included establishing Canadian residency for family members, creating Canadian corporate structures to hold intellectual property and business assets, diversifying liquid wealth into Canadian financial institutions, purchasing Canadian real estate, and obtaining Canadian citizenship for children to provide options for the next generation. The planning documents and advisory memoranda describing these strategies, which leaked through professional networks despite confidentiality agreements, revealed that the worst-case scenarios being contemplated by wealthy families were far more severe than anything discussed in public political discourse. These families were preparing for possibilities, including American debt default, major currency devaluation, or political breakdown affecting rule of law. Whether these scenarios were realistic was almost irrelevant. What mattered was that people with resources to protect their wealth believed these scenarios were possible enough to justify expensive and complex preparation. And those protective actions, taken in aggregate by thousands of wealthy families, were themselves contributing to the deterioration they feared by removing capital, talent, and tax base from American jurisdiction. This is not temporary capital movement that will reverse when political conditions stabilize. These are permanent relocations of corporate operations, individual residences, and family wealth that reflect fundamental loss of confidence in American institutional stability. The banking relationships, corporate structures, real estate holdings, and residency arrangements being established are not easily reversed. The executive, who relocated family to Toronto and established children in Canadian schools, is not moving back to Texas because American election outcomes change. The corporation that restructured intellectual property holdings into Canadian subsidiaries is not reversing that structure because trade policies shift. By the time political conditions in the United States hypothetically stabilize, the capital will have found new homes, the talent will have established new lives, and the economic activity will have created new networks that do not depend on American markets or American jurisdiction.